Hello and welcome. Today's Thursday. It's May the 21st. We're recording this a little bit early this week for scheduling. So thank you for joining us. So a couple big, the big story here in the ag economy is we have some more details around the CFAP, I guess CFAP program. Of course, this was an extension of the CARES Act. A lot of it was an extension of the CARES Act. So about a $19 billion program, 16 billion of that going into direct payments to producers. We wrote this article a couple weeks ago looking at what's going on with direct payments. I guess if you add that to the baseline that we already had back in February, we're in the $30 billion ballpark, way ahead of last year. Still, 35 billion would be a historic inflation-adjusted record. We asked about 40 billion. And Brent, the thing that jumped out at me is that for row crop producers, there's no 2020 production plan in place. The row crop, the grain producer payments were the 19 crop, this storage situation. So I guess, I thought there'd be some 2020 dollars or in there for 2020 production, but there wasn't. So Brent, what are you thinking about for that?
Well, first of all, that the program is like a down payment, I think, on 2020. So probably more coming eventually. I don't tweet very often, but I tweeted something like destination, 40 billion or bust. I think highly likely there's going to be more coming eventually. There was, I would say the reaction on Twitter was really interesting, ranging most of it complaining, which is 90% of what Twitter is anyway. People complain about something. A lot of people complaining about this being paid on, grain and storage. And I will be honest, I'm one of the people. I looked and I had sold quite a bit of crop on January 13th. So get the short end of that one. But think about it. I just think when we put it all in perspective, you step back and think about it. Here's the reality. Reality is USDA had to put a bunch of money in the farm sector to make it work. It had to happen. So they've got to have some way to put it out there. They came up with a way. It didn't matter whether they paid it on stuff as of January 15th or January 30th or March 1st, whatever. They're going to put the money in, and there's always going to be distributional issues. The same thing happened with market facilitation payments. I mean, the last time they made them, they just based them on county. They paid them out on counties, and you had counties that don't grow any soybeans are getting payments, and some places grew lots of agricultural stuff didn't get very big payments, and others got huge payments. There's always an issue of distribution when you start putting that kind of money to work. It wasn't going to matter. The big picture thing is they put the money in, and it was needed. And there's always going to be grousing about, did it go to the right people? I think you'd have that problem no matter what mechanism they used. The big picture again is it was needed. It's going to be out there. It's going to help some people a lot, others not so much. But I think they had to do something.
I completely agree. So a couple points. 9 billion of this went to livestock. Again, they were not in this MFP programming in the past. So a big chunk of this was sort of a new slice to a pie. The other thing to keep in mind is they only had about $3 billion earmarked for row crop producers or the grain producers. And that's about 25% of last year's MFP. So if they would have spread that over everybody, there would have been a lot of complaining about a pretty small payment going around. And so I think they were looking at this. They had, it was $3 billion. That's a lot of money. But when they started splitting it up, there wasn't a lot of places to split that up to. And so I think in the grand scheme of things, they didn't have a lot of money in this tranche for the crop producers. And so they got, $3 billion into the farm economy. They're going to get that done pretty quickly. And I'm with you. I think there's a really high chance there's going to be a bigger program coming for the row crop producers. I think the question is how much of that gets into the 2020 calendar year for tax planning and the purposes of our forecast network question, but we have a long time to go here. And if the USDA is following pattern, we have sort of three waves, right? We have the big announcement that we're going to do something. We have the next big announcement of how much money it's going to be, X billion dollars, and the third announcement, the third wave of announcement, it's here's how you're going to calculate it on your farm. And so we could be, we're probably at the end of July or August before we really start thinking about a next program. I also, Brent and I have been talking about this a lot. I think this program proved how difficult it is to pass anything other than an income support program like the MFP. We've been wondering about supply controls or a grain reserve storage program, price support program. Those just are going to be hard to pass politically, and Twitter lit this program on fire because it talked about, it highlighted the inequities that we talked about.
Yeah, it's always tricky to come up with new ways to dump money in, and I guess they came up with a new one this time. I had a feeling it was going to be based on inventories, just based on reading the previous announcements of it. I was a little surprised at what it was, and then the other thing that there was a huge amount of misinformation and miscalculation that got circulated after that announcement. And I had people show me graphs that were just completely incorrect of how big the payments were going to be. And, that was a little frustrating too. But like we said, I think, they needed to do something. Whether it all went to where it should have went is a debate for later, I guess. It's done now.
All right, Brent. So we both wrote supporting articles this week, thinking about the WASDE report that came out about 10 days ago. Our first look at the 2020-2021 marketing year. So you kicked it off. So why don't you talk about your article, and then I'll follow up with the one I looked at.
Yeah, I looked at the ratios, supply and demand, or stocks to use ratios. So basically how much grain is left over relative to use. And what you find is that's 22% in corn, and that's a big number. In fact, it's the biggest one we've seen since 1992. So that's not a good picture. So I kind of went back and did the relationship between market year average prices and different stocks use ratios. And what you find is a nice downward sloping curve, just as you would expect, that shows when stocks are tight, we get high prices. When they're ample, we get low prices. And the problem with this one is we just haven't been in this territory for a long time. So it's really hard to know. And if you just look at the data, you kind of go, well, maybe USDA was generous at 320 market year average price based on what the data would suggest. And so I kind of went back and said, well, okay, how many other times have we been this wide? We've been way bigger. I mean, we're in the 60% range back in the 80s, which was just terrible. But we haven't been here for a while. The last time like I said, it's been some time. But I think there's a couple things to keep in mind. Sometimes we were in a tighter stocks to use situation. We actually had lower prices. That's the 1990s. Before ethanol. So ethanol, I think, has always been thought of as a stable source of use or demand. Now it's floating around a little bit as well too. So I think the bottom line of all of this is that this is a burdensome situation for prices. And really the only way it's going to change is we have fewer acres of corn, we have lower yields of corn, or we have more demand. Where's demand going to come from? Well, it could come from exports, it could come from more ethanol, it could come from more livestock feeding. It just, right now, there's not a lot of momentum for any of those to get a lot bigger. And And then on the supply side, there's still a lot of uncertainty out there about production. And I think there's some uncertainty about how many acres of corn actually went in. So there's maybe some positives there, but overall, it's a negative situation, and looks like it's going to take a lot to get us out of a range that doesn't result in pretty low prices.
Yeah, it's a challenge. And you were talking about this idea of additional usage. And so I stepped back and said, okay, what's been going on with usage? And I looked at the trends in usage, and specifically I looked, okay, what's been going on in the last 20 years? And similar to what we would do with yields, I said, what's going on over time, and how much does time explain? And it's kind of interesting. There's a lot of hand waving and palm reading and tea leaf reading especially on Twitter, of usage is up or usage is down. If you put a linear trend line through this, it's surprising how much is just the upward trend over time. So that was the first big takeaway. And then I looked at it and say, okay, some years are good relative to trend and some years are bad relative to trend, and what has been going on, and where is 2020 shaping up for the moment. And I did this for corn and soybeans, and in general, I guess the first big takeaway is the drop in usage here in the last marketing year, 2019, 2020, was really historically big. On a percentage basis, it was the third largest drop that we'd seen in the last 20 years. And the frustrating thing here is that we had below trend yields, and so that we had low production, and we had demand cutting back or usage cutting back, but we also had lower prices. And so it's one of those like, darn, we really missed probably a historically looking, we should have saw some better prices this time of the year, and we didn't. And it's one of those lost opportunities. We talked about lost opportunities when we have the trade war, and this is another example of demand sort of upsetting an otherwise good old-fashioned production hiccup. So then I said, okay, where are we at for this year? And the USDA is a little bit below trend on their current projections for corn. They're a little above trend for their production usage estimates for soybeans. You should take a look. There's a lot of data in there. I also highlighted and commentaried some alternative headlines you could see floating around. So here's three examples for this 2020, 2021 soybean story. One is usage has improved. It's returned to trend. One of them is usage has soared up 11% from last year. And the other one is usage reached all-time record highs of 4.3 billion bushels. And it's sort of all in the way you look at it, all in the way you slice the data. Again, similar to what Brent was saying earlier, no matter how you look at it, corn and soybean usage is up considerably from last year. And we really have to take pause and say, how optimistic is that? It's close to trend, but we actually got to dig ourselves out of a hole here. And in a future post, we're going to actually break that apart a little bit and actually say, how is corn usage going to increase? What's it coming from? And spoiler alert, it's the feed and residual category. It's not export. It's a little bit exports, and it's a little bit ethanol, but ethanol's been on a downward trend here, and that's been a real challenge. So take a look at that article. It's a lot of data and a lot of moving pieces, but I think you'll find it interesting.
Yeah, absolutely. I did.
So I've updated my forecast on the probability of direct payments getting over $40 billion here this year. I'm pretty confident that's going to happen. I wonder if 45 or 50 billion might not be a good question for us to think about. 50 billion would be a stretch, but it's definitely working. There's another article that looks at ag labor. Take a read of that. I found it interesting. Just sort of two narratives going on in ag labor. One of them is, how do we get enough workers to come in? And the other one is the idea of kind of a workers' bill of rights, and what are some things that are going on. This has been introduced, and so it's kind of adding cost to the system. And so we have this weird convergence in these labor markets. It's been hard to get some of the labor forces, especially those relying on on immigration and seasonal labors. That's been a challenge there. And now maybe looking at raising the costs associated with the labor forces. The meat plants are putting in more PPE equipment, and that's all added cost. So it's an interesting combination of factors in the ag labor market. So Brent, anything you've been looking at or updating your forecasts on?
No, I mean, I'm really, the stocks to use situation has me really thinking about, the likelihood of these different price levels occurring, and trying to, just trying to be rational about, the situation we're in, and then make some decisions about it.
Yeah. We've been thinking and talking a lot. We'll probably put something out in a little bit about the reopening, and we're starting to see the economy start to reopen. We've seen gasoline consumption start to turn a little bit higher, but I guess I've been looking at the data and looking at my experiences, and sort of on one hand, things are moving, and on the other hand, they're very sticky. And so we'll flesh out some ideas on that and get it going.
Yeah, this whole virus situation is really hard to kind of get your head around. I mean, I think I'm probably in the more optimistic camp about how I think it's going to resolve fairly soon, but I'm maybe in the more pessimistic camp on how bad the economic damage is. You start getting over 30 million people that were in the workforce unemployed, and we have major problems. And I'm not sure that everybody's kind of come to terms with just how bad that actually is and what the implications of that actually are. And so, that's you hear the doctors talk about, well, we got to do this for another 18 months or something. I just don't think it's feasible. The economy will absolutely come apart at the seams if it were to last that long.
So, three anecdotal points from my experience that are conflicting. One of them is that preschool for my little guy isn't going to open until sometime after July 6th. July 6th would be the earliest. So it's a very sort of long range, slow to reopen and sticky. And even when they go back, might have kids over the age of 2 wearing masks. So it's a very very cautious approach. Same town. The pools are opening this weekend with social distancing, limited capacity, but the pools are reopening. The zoo will open up next week. And then, to Brent's point about unemployment, a lot of places have signs up. A lot of restaurants that are starting to reopen have signs up saying help wanted, hiring all positions. And so I'm wondering what happened to the people. Are they hiring new people? Did they lay people off and they can't hire them back? It's just a very, I find it odd that there's help wanted signs because a lot of laying off's been going on. And so I don't know how to triangulate against these three almost conflicting stories that have emerged.
Well, just take the PPP loans. I mean, okay, we dumped $1 trillion in the economy of PPP. What the heck happened to that? In order to get those forgiven, you're supposed to maintain employment. So, did none of that take, or it's just getting our head around the scope of the economic damage is really difficult. And I think it's more complicated in that it must be a lot worse in the larger cities. So, and I don't go there, so I don't know what the situation really is, but it's going to take a while to uncover from all of this economic damage, and the sooner it starts to get better, I think the better off we'll be as a country.
Well, I think I couldn't agree with that statement anymore. A little long today, but we have a lot to cover. Good luck with your forecast. Make sure you update your forecast, and we'll see you again next week. Thanks.